The great thing about self-managed super funds, of course, is that we have control over the assets we invest in, and we can essentially invest in anything within the super fund that we can invest in outside of super, within the realms of super law. And there are a few restrictions, but generally it's all the usual things. So cash, fixed interest and bonds, managed funds, shares, so listed securities on the ASX we can trade, and then of course there's the opportunity to invest in real property, both residential and commercial property. And another one that we consider an asset of the fund is insurance. So we can also use our self-managed superannuation fund to acquire insurance for the members to protect them and their families in the event that something goes wrong, in the event that they become incapacitated or someone passes away. So we're able to do all of those things within a self-managed super fund. So let's look at those. There is of course cash and fixed interest, and there's probably too much money in that particular asset in the country at the moment, and that's just due to the volatility of the markets and the fact that people contribute money to their funds and then forget to turn around and then invest that money into assets. But if we do kind of get to the investment stage, we have the opportunity to invest, as I said, in managed funds and access assets that might not be able to normally, like international equities, certain commodities and emerging markets. We can trade securities, and having our own fund means we can really react quickly with markets. We can use our own broker or an online broker to react quickly and make decisions around those kinds of securities. And then there's the ability to invest in property, which we just don't have in other types of superannuation fund. So within a self-managed superannuation fund, we can pool members' money together and potentially access big items like residential investment properties and commercial business properties, even business properties where we're operating our own business, and we can move that into the fund and pay rent to our own superannuation fund and claim expenses within the superannuation fund as tax deductions. Now that works really effectively because we're in a concessionally taxed environment. So the most income tax that a fund pays is 15%, and on capital gains usually only 10% if we hold the asset for 12 months. And potentially within a self-managed superannuation fund you could hold an asset right through to retirement and pay no capital gains tax at all when you dispose of that asset. So that's a massive opportunity, isn't it, for real property, for business property and residential property, because of the kinds of capital growth that we can achieve. So the ability to, acquire an asset, accumulate capital gains and then sell it without paying tax is a huge advantage. And then we have control over the type of insurance and the level of insurance that we want within the superannuation fund. So that can provide real, security to family members, particularly where they have dependents. And we can also do things like fund, estate planning objectives and things like that through our self-managed superannuation fund. So lots of opportunities in terms of the investment. And one additional one that I haven't mentioned yet that we'll address in the next question is the ability now for funds to borrow. So we can actually borrow to invest in certain assets, and this really comes into play with property, the ability for us to borrow a certain amount of money, put it together with some of the money in the fund and acquire a business property or a residential property as our investment through to retirement. And that also, of course, because we've been able to leverage up and gain lots of exposure, we can use the other fund assets to diversify and invest in other types of things. There's also some other items that we can invest in, what we call exotic type assets. You can invest in fine art and fine wine if you really wish. Probably not our recommendation, just because they don't really provide an income to you in retirement. But nevertheless, there are those opportunities there for specialist type investors. So we have lots of flexibility, and the key here is really to ensure that you have really good investment advice, because with that increased control, of course, comes increased risk that your fund won't perform as you want it to. But nevertheless, a much broader kind of world of investments than you would otherwise be able to access.